Hi, I'm Saima, an experienced management consultant. I've spent last 12 years in large organizations providing advisory and consulting services to business clients within the financial services, capital advisory, sports media, and marketing and advertising sectors. The financial models being offered at Fin Analytics Lab provide businesses, investors, and financial professionals to analyze performance, forecast future scenarios, and make data driven decisions. Welcome to our deep dive into capital investment models. Whether you are an investor, business owner, or finance professional, understanding how capital investment decisions are made is crucial for maximizing returns and minimizing risks. In this video, we'll break down key models, their applications, and how to choose the right one for your needs. So, let's get started. A capital investment model is a framework used to evaluate long-term investment decisions, like buying machinery, launching a new product, or expanding operations. Unlike day-to-day expenses, capital investment have long-term impact, so choosing the right model is critical. A model that can answer typical questions like, is this investment profitable? How long will it take to recover costs? Or what are the risks? The payback period calculates how long it takes to recover the initial investment. Simple and intuitive, but ignores cash flow beyond the payback period. For example, investment is like you have made 100,000 and the annual cash flows are 25,000. Payback period is within 4 years. So this is simple but ignores long-term profitability. The other model is net present value. So net present value or NPV accounts for the real-time value of money. Future cash flows are discounted to today's dollars. A positive NPV means the investment is worthwhile. Let's explain net present value with an example. Let's say you have invested initial cost of 200,000 with a 5-year cash flows of $50,000 a pound per year, and you have used discounted rate of 10%. So the net present value would be calculated as negative or positive. So according to net present value, decision rule is accepts if net present value is greater than 0. The other model is internal rate of return. So it's called IRR. Is the discount rate that makes net present value 0 if internal rate of return is greater than required return, the project is viable. For example, project A internal rate of return is 15%. Company's hurdle rate is 12%. Since 15% is greater than 12%, so we'll accept that project investment. The other model which is used is called profitability index. The profitability index measures bang for buck, how much value you get per dollar invested. And the formula used is present value of future cash flows divided by initial investment. So the decision rule would be if profitability index is greater than 1, then it's good investment, and if it's not, then it's not good investment. Simple rule. So the question is, how do we choose the right model? Shall we choose the payback period, net present value, or internal rate of return, or profitability index? The answer is quite simple. Different models suit different needs. For example, if the investment focuses short term, then payback period is the best model to be used. And if the horizon is long term value, so net present or internal rate of return would be considered. And if there are capital constraints, then profitability index would be used. And you would also need to consider real world considerations as well. For example, risk tolerance, industry standards, strategic goals of an organization or of an investor, how much he's willing to take the risk, and what would be his objectives. So let's use a case study example. For example, fictional company, let's call it XYZ Manufacturing, considering a 500k machinery investment. XYZ evaluates a new machine using payback period, which is calculated as 3.5 years. Net present value is coming at positive 120k or 120,000. Internal rate of return is being calculated as 18%, and the profitability index of the project investment is coming at 1.24. So the verdict is it's strong investment, so it should be approved. Now you know the essentials of capital investment models. Each has strengths. Combine them for making smarter decisions. If you need any Excel template to run these calculations, you can visit us at finanalyticslab.com. Don't forget to like, subscribe, and hit the bell for more financial insights. Thanks for watching. The financial models being offered at FinAnalytics Lab provide businesses, investors, and financial professionals to analyze performance, forecast future scenarios, and make data-driven decisions.